Disclaimer. This video is for educational purposes only and is not financial advice. Investing involves risk, and everyone's financial situation is different. Always do your own research before investing. How much passive income can $100,000 generate in Canada? How much passive income can $100,000 actually generate in Canada? Most people hear six figures and imagine quitting their job overnight. But the reality is more nuanced. Depending on how that money is invested, $100,000 could generate a few $1,000s per year, or much more. The catch? Higher income usually means higher risk. So in this video, we'll break down realistic passive income expectations for beginner investors in Canada. Section 1. What passive income really means. When people talk about passive income from investing, they usually mean money generated without actively working for it. That can include dividends, interest, ETF distributions, rental income, or capital gains from investments. For beginner investors, one of the simplest approaches is investing through ETFs. ETFs are exchange-traded funds. They let you buy many investments at once instead of trying to pick individual stocks. And in Canada, many investors use accounts like a TFSA or an RRSP to invest more tax efficiently. But here's something important beginners often misunderstand. Passive income is not just about yield. Total return matters too. Because an investment paying a very high yield can still perform poorly overall if the value of the investment drops over time. That's why experienced investors usually focus on balancing income, growth, and risk. Instead of chasing the highest yield possible, Section 2, Conservative Income Estimates. Let's start with a more conservative example. Imagine someone invests $100,000 into broadly diversified ETFs. These might include Broad Canadian Market ETFs, US Market ETFs, or globally diversified index funds. Many broad market ETFs historically produce dividend yields somewhere around 1.5% to 3%. That means $100,000 invested could generate roughly $1,500 to $3,000 per year in cash distributions. That works out to approximately $125 to $250 per month. Now, for some people, that sounds disappointing. But this is where long-term investing becomes important. Because broad market ETFs are usually designed for total return, not just income today. Historically, long-term stock market returns have also included capital growth over time, meaning your investments may grow while also paying distributions. And for younger investors especially, reinvesting those distributions can become extremely powerful over long periods. So even though the monthly income may look modest initially, the combination of growth and compounding can matter much more later. Section 3. Dividend ETF Approaches. Now let's look at dividend-focused investing. Some Canadian investors prefer dividend ETFs because they typically generate more cash flow. These funds often focus on companies that regularly pay dividends. Examples can include sectors like banks, utilities, pipelines, telecommunications, and large established companies. Dividend ETF yields are often somewhere around 3% to 5%, although this varies over time. So with $100,000 invested, that could potentially generate $3,000 to $5,000 annually, or roughly $250 to about $420 per month. This approach can feel psychologically rewarding because investors see more income arriving regularly. But there are still risks. Dividend stocks can decline in value. Dividends are never guaranteed. And concentrating too heavily in a few sectors can reduce diversification. That's why many beginner investors combine broad market exposure, with some dividend exposure. Instead of relying entirely on one strategy. Section 4, higher yield investments. Now let's talk about the investments that often attract the most attention online. Higher yield investments. These can include covered call ETFs, REITs, income-focused funds, or other high distribution products. Some of these investments advertise yields of 6%, 8%, 10%, or sometimes even higher. So naturally, many beginners think, why wouldn't I just buy the highest yield possible? But this is where understanding risk becomes critical. Higher yield often means more volatility, slower growth, reduced diversification, or greater long-term uncertainty. For example, a very high-yield investment might generate $8,000 or even $10,000 annually on $100,000 invested. That sounds attractive. But if the investment loses significant value over time, your total return may not be as strong as expected. Some higher yield products can also reduce future growth potential in exchange for generating income today. So income investors need to think beyond just the yield number itself. The key question is not only how much income does this generate, but also how sustainable is that income long term? Section 5, the reality. Most people don't talk about. Here's the reality many finance videos skip. Building meaningful passive income usually takes time, consistency, and significant capital. Even with $100,000 invested, most beginner investors are not generating enough income to fully replace a salary. And that's okay, because investing is often more about gradually increasing financial flexibility over time. For some people, an extra few $100s per month can already make a meaningful difference. It could help cover groceries, utilities, part of rent, or allow more money to be reinvested. And over decades, consistent investing can potentially snowball into much larger income streams later. That's why many long-term investors focus on steadily adding money, reinvesting distributions, and avoiding emotional decisions, instead of trying to get rich quickly. Section 6, common beginner mistakes. Here are some common mistakes beginner investors make when pursuing passive income. First, chasing extremely high yields. If something promises unusually high income with little risk, be cautious. Higher returns almost always involve higher risk somewhere. Second, expecting instant results. Passive income from investing is usually built gradually over many years. Third, ignoring diversification. Putting all your money into one stock, one sector, or one strategy can increase risk significantly. And fourth, misunderstanding total return. A portfolio generating lower income today may still outperform long-term if it grows more consistently. That's why understanding both income and growth is so important for beginner investors. Conclusion. So, how much passive income can $100,000 generate in Canada? Realistically, conservative diversified investing might generate around $1,500 to $3,000 annually. Dividend-focused investing may generate around $3,000 to $5,000 annually. Higher yield approaches may potentially generate more, but often with significantly higher risk. There's no perfect answer. It depends on your goals, your risk tolerance, your timeline, and your investing strategy. But for most people, successful investing is less about chasing unrealistic income and more about building sustainable wealth over time. Outro. If you're starting your investing journey in Canada, I'm building a simple step-by-step guide on this channel. Consider subscribing so you don't miss the next part.